Good morning, students. Now we are moving on to Unit 2, Forms of Organization, Business Organization. In this sixth chapter, we are going to see about joint stock companies. Already we have seen about sole trader, Hindu undivided family, uh, partnership firms, their features, advantages, everything we have seen. And in this chapter, we are going to see about joint stock companies. So the learning objectives will be to know the meaning of joint stock company, the characteristics, advantages and disadvantages of joint stock companies, the types of companies, the memorandum of association and its contents, the articles of association and its contents, the prospectus and its contents. And these are the three important documents which are involved in joint stock companies. That is the memorandum of association, the articles of association and prospectus. So these are the three important documents which are involved in joint stock companies. Now let us begin the chapter with why this joint stock company actually came into evolution. So a joint stock company can be said that it is a distinct type of business organization which evolved to overcome the limitations of sole trader and partnership forms of concerns. So there were certain limitations in both these organizations, namely the sole trader and the partnership. And also the advancement in science and technology and the impact of industrial revolution have all necessitated a large amount of capital investment was required, and highly sophisticated managerial skill was also required for running the large scale industry. As a result, partnership, with its limitation of its capital and managerial ability and with the added risk of unlimited liability, has been found unsuitable for running large scale industry in modern times. Therefore, joint stock companies form of organization came into existence. So you should be familiar with this. You should know why joint stock companies actually evolved. Since there were lots of limitation in both sole trader and partnership forms of organization, the joint stock companies evolved. So in the previous times, joint stock companies in India are governed by the Companies Act of 1956. Previously, it was governed by the Companies Act of 1956, but now they are governed by the Companies Act of 2013. Please note down. Earlier, it was governed by the Companies Act of 1956, and now it is governed by the Companies Act of 2013. The new act has been divided into 29 chapters and 470 sections. So previously, the act consisted of nearly 658 sections. So the Act of 2013 has 470 sections as against 658 sections in the Companies Act of 1956. It actually brought down the difficulties in the act, and after lots of detailed consultative process adopted by the government, the Companies Act of 2013 was passed, and the entire act has been divided into 29 chapters, and many new chapters have been introduced, such as registered valuers, chapter 17, government companies 23, and so on. So, the Act is forwarded looking in its approach, which empowers the central government to make rules through delegated legislations. And this has been mentioned in the section 469. So, 2013 Act, that is the Companies Act of 2013, is a result of detailed consultative process adopted by the government. There were certain limitations in the Companies Act of 1956, and all these were set right by the discussion of the consultative process by the government. So this you should know. So the act came into force on 12th September 2013 with a few changes. Like earlier, private companies the number of members was only 50. That is, the maximum number was only 50 in case of private companies, and now it is 200. So note this point. This will be a 1-mark question. Earlier, according to the Companies Act of 1956, the maximum number of members in a private company was only 50. But now, according to the Joint Stock Companies Act 2013, the maximum number of members who can be involved in private companies is increased to 200. So a new class of company is of one-person company is included in this act. That will be a private limited company. So one-person company. That is also included in the Companies Act of 2013. So now let us go to, all this is introduction that I have given you. Now let us go to the definition. So definition of joint stock company. A company means a company formed and registered under the act or existing company. That is the Companies Act of, actually this is a Companies Act of 1994, but we are following the rules and regulation that is laid down or governed by the Companies Act of 2013. That is the latest act which governs the joint stock company. A joint stock company is an association of many persons who contribute money or money's worth to a common stock and employ it for common purpose. Joint stock company is a new venture in the big business area. After industrial revolution, there must be changed in the production system. So as a result, joint stock companies resulted. All these things we have seen in the introduction itself. And the definition that is given in our textbook is according to section 2 of the Companies Act 2013 and Lord Linley. So Justice Linley, that is the definition that I have shown you in the slide here. So first let me give you the definition which is given by Justice Marshall. A company is an artificial being. What does it mean? It is an artificial person, not a human being. It is an artificial being. Being means it doesn't have life. Artificial. It doesn't have, it is not a living thing. It is a non-living being. Invisible. It cannot be seen. Intangible. It cannot be touched or felt. And existing only in the contemplation of law. It is existing only in the eyes of law. So it doesn't have any form. That is the meaning according to Justice Marshall. Then the next one is Justice Linley. A company is a voluntary association or an organization of many persons. So it is a combination of many persons, or many persons are involved in a company form of organization who contribute money or money's worth. Again, the same meaning is repeated here. Money means capital is invested by many people, or money's worth, even equivalent to money. That can, for example, the efficiency or ability of a person, that can also, name also can be contributed to a common stock and employ it in some trade or business, and who share the profit or loss arising therefore. And right from the beginning we have seen that a business is formed only to share the profits or gain profit. So here also joint stock company is also formed to contribute money or money's worth and employ it in a trade, some trade, and that trade should be legal. Again, we have already seen it in partnership form itself. Trade or business, and who share the profit or loss arising therefore. So they have to share both the profit as well as the loss. So this is the definition of joint stock company, and you could see it in page number 47 in your textbook, Lord Linley, and also section 2. Let me also give the definition according to section 2 of the Companies Act of 2013. A company is an artificial person. This was actually given by Justice Marshall. Artificial person created by law, having a separate entity with perpetual succession. Perpetual means permanent. Succession means life. Permanence, life, and common seal. The common seal is considered as the signature of the company, and the common seal can be affixed in any document, and that will be considered as legal, and it will be treated as the signature of the company. Now let us move on to the characteristics of the joint stock companies. So let me give the points here. There are 12 points given here. Corporate personality. So formation, how it is formed, all these things we'll be saying. Corporate personality. It is having a personality according to law. Joint capital. More people will be contributing. Share capital, that is the investment. Transferability of shares. So this is a unique feature which is found in joint stock company form of organization. Limited liability. This is also the greatest advantage of joint stock companies. And statutory responsibility. Number of shareholders. Independent nature of management. Democratic norm. Profit distribution. Tax payment and dissolution. These are the important features of joint stock company. Let us go one by one. Let me explain one by one. A company. Now let me start with some introduction and then I'll go by the points there. A company is an entity which has many distinct features which together make it a unique organization. So this has got some special features so that it is outstanding compared to the other forms of organization. The essential characteristics of a company are as follows. Separate legal entity. This is a greatest feature, or this is one of the outstanding features which other forms of business organization doesn't have. So, under incorporation of a company, because under incorporation, after incorporation, that is registering. Incorporation means after starting it and getting it registered under the Companies Act of 2013, it becomes a separate legal entity. It becomes a separate body, and as compared to its members. So the members are considered separate and the company is considered as separate. Whereas in a sole trading concern, both the business and the sole trader, they were considered one and the same. And in partnership form of organization also, we could slightly have or what is say is actually whatever affected the partners, that affected the partnership firm to some extent. Not exactly as in the case of sole trader business, but in this case there is a separate distinction between the members and the company, so and the business. The company is distinct and different from its members, and its own seal, and it has own name. Its assets and liabilities are separate and distinct from those of its members. Everything is separate, and it is capable of owning property, incurring debt and borrowing money, employing people, having a bank account, entering into contracts, and suing and being sued separately. In short, it is considered as an artificial person created by law. Whatever can be done against a person, against a human being, that can be done against the company form of organization. Say for example, a person could buy assets means a company can also buy assets. And liabilities are separate, and incurring debt can be incurred by a human being, then the business can also incur debt. Borrowing money, that can be done by a human being. Even a business can borrow money. Employing people, that can be done by board of directors. This can also be, company can also employ people. Having bank account, that is a distinct feature of human being actually, but a bank account can be maintained in the name of a company also. So it is considered a company, a joint stock company is considered as an artificial person created by the law, and it is registered under the Companies Act of 2013. So the next feature is limited liability. This is another important feature which is not available in case of sole trader and partnership form of organization. The liability of the members of the company is limited to the contribution of assets of the company up to the face value of shares held by him. Let me give you an example here. Say, for example, A is a shareholder in XYZ company, and this person A is holding a share of up to rupees 50,000. This is an example just I am giving you, and his liability is equal to 50,000 rupees only. He is not liable to pay even 1 rupee in excess of this 50,000 rupees. Are you clear with this? Suppose A is a member in XYZ company and his investment is rupees 50,000, or his shareholding or his shares value is rupees 50,000, then he is liable to pay, or he is liable to pay the debt, or he can be asked to pay only to the extent of rupees 50,000, and not a single amount or single paise will be asked to be paid by him in excess of rupees 50,000. So if the assets of the company are not sufficient to pay the liabilities, the personal properties of the shareholders are not held responsible. So his personal property is very safe in the case of joint stock companies, whereas in case of sole trader and partnership firm, even his personal property will be taken into account for paying the debts of the business. So this is not the case in case of joint stock companies. The next important feature is perpetual succession. Perpetual means permanent. Succession means long life, existence. Perpetual existence or succession. It will be going on, the continuance of the business. A company does not cease to exist unless it is specifically wound up or the task for which it was formed has been completed. So when will a business come to an end in case of joint stock companies? When it is specifically wound up, or when the task is finished, or when the objective is finished, achieved, then the business will be wound up. In case of partnership firm, we use the term dissolution, but in this case we are using the term winding up of the business. So that is, the winding up means putting an end or putting a termination to the business. Membership of a company may keep on changing from time to time, but that does not affect the life of the company. So anything that affects the person in members involved in joint stock company is not going to affect the company's life. A company is created by law and it can be wound up only through legal process. Say, for example, a member dies in a joint stock company. It is not going to affect the company's life. It will go on. New members can come into the company, and some of the members may go out of the company, or they may be expelled from the company. So all these process does not affect the life of the company. So this you should keep in mind. That is the feature of perpetual succession. Separate property. This is another important feature of joint stock company. So a company is distinct legal entity. We have already seen that it is a legal being which is created by law. A member cannot claim to be the owner of the company's property during the existence of the company. So separate. The company's property is separate and the member's property is separate. The member cannot claim that the property of the business is his. So that is not allowed in the case of joint stock company. Transferability of shares. That is the fifth feature or characterization of joint stock company. Shares in a company are freely transferable. from one company to another company or from one person to another person. When a member transfers his share to another person, the transferee steps into the shoes of the transferor and acquires all the rights of the transferor in respect of those shares. There are restrictions in the transferability of shares in case of private companies. So, a member in a company can transfer his shares easily to another member in the company with his consent. So, the person one who transfers the shares is called as a transferor, and the person one who receives the shares is called as a transferee. Next feature is common seal. Common seal, I told you, it is actually an emblem or an image or some sort of inscription which could be affixed to any document, and that will be considered as the signature of the company. A company is an artificial person and does not have physical presence. We have already seen that. It is a legal person, but it doesn't have any form as a human being. Thus, it acts through its board of directors for carrying out its activities and entering into various agreements. Such contracts must be under the seal of the contract. The common seal is the official signature of the company. Mark it down. This is a one-word question. The common seal is the official signature of the company. Dash is the official signature of the company. Then you can easily say that it is the common seal. The name of the company must be engraved on the common seal. Any document not bearing the seal of the company may not be accepted, authentic, or proof. It will not be valid. It is not considered as valid. Any document which is not affixed with the common seal of the company is not valid and may not have any legal force. So it is not worthy. So it will be considered as invalid. So the seventh one is capacity sue and being sued. So a company can sue or be sued in its own name as distinct from its members. So it can claim any sort. It can file a case in the courts of law, and it can be filed against a case in the courts of law by a third party or by any person. Separate management. A company is administered and managed by its managerial personnel, that is the board of directors or the managing people or managing personnel. They will be controlling all the affairs of the company. The shareholders are simply the holders of the shares in the company and need not necessarily be the managers of the company. Shareholders need not involve in the management of the company. All the managerial activities will be done by the board of directors. Whereas in the case of sole trader and partnership, everything will be carried on by the sole trader and the partners inside the partnership firm. Whereas in this case, the company, joint stock company, the members, they are not involved in the managerial abilities or managerial work of the company. Everything will be carried on by the board of directors. So this point also you should keep in mind. One share, one vote. This is a distinct feature of joint stock company. The principle of voting in a company is one share, one vote. That is, if a person has 10 shares, then he has 10 votes in the company. So this is in direct distinction to the voting principle of cooperative society, where one member, one vote principle applies. That is, irrespective of the number of shares held, one member has only one vote. So one share, one vote. That is the principle followed in a joint stock company. Suppose Mr. Akash is a shareholder in XYZ company and he holds 10,000 shares. Then in the general meeting, he has the power to vote 10,000 votes, or 10,000 times he can vote in the meeting. And he has the right to exercise his vote 10,000 times. Whereas in the case of cooperative societies, Each and every member has only one vote irrespective of the number of shares held by him. So that is the distinction. Now let us move on to the advantages of joint stock companies. The power and the presence of corporations in American business suggests that this form has certain advantages over other forms of business ownership. High amount of capital, that is large capital. Then the important advantage is limited liability. Then transferability of shares, that is also possible. Perpetual succession is possible in case of joint stock companies. Promotion of saving and interest habit. Risk bearing, low risk investment. Then economies of large scale operation. So economic development is possible in case of joint stock companies. So these are some of the advantages. Let us see the advantages in detail. Large capital. So when you want to extend, because of, already in the introduction I told you, because of the technological development and improvement in science and technology, the business has started to flourish, and each and every business has been keeping on expanding. So as a result, the investment also increased. And this was not possible in case of sole trader and partnership firms. So only joint stock companies where more number of members could participate in the business paved way for large capital. A company can secure large capital compared to sole trader or partnership. Large amount of capital is necessary for conducting the business on a large scale. For example, Reliance has invested more than rupees 25,000 crores in its telecom venture. Raising such huge amount of funds would be utter impossible in a sole tradership or partnership. 25,000 crores of amount is a very huge capital, and this is possible only in joint stock companies because they can attract shareholders. Even the public can invest in the shares of certain companies. Limited liability. The liability of shareholder is limited. In the case of a company limited by guarantee, his liability is restricted to the amount that he has guaranteed to contribute in the event of winding up of the company. So how much amount he has guaranteed during the time of winding up will be his liability. Transferability of shares, already we have seen in the advantage itself. Transaction of shares between two individuals is easy in case of joint stock companies. So there is liquidity of investment. Easily the shares can be sold out and cash can be realized easily. Any shareholder can easily convert his shares into money by selling his shares in the stock exchange. And this will be seen in the further chapters. Perpetual succession also is an advantage again. So is a feature of joint stock company. A company has perpetual and continuous existence. Members may go or new members may come in, but the company continues to exist. This ensures continuity in operation, and the company can undertake long-term investments. There is no risk of just the business being wound up at any time. Even if anything happens to the members, it is not going to affect the business here. Promotion of saving and investment habit. So this is one of the economical activities which is a distinct advantage of joint stock company. The joint stock company system encourages people to save. It encourages people saving habit. Even small amount can be used for the purchase of shares. A person can buy even one share of a company. Say for example, if a person is having 500 rupees, then you can invest that 500 rupees by buying shares from a company. Any company. You can go to a stock exchange, consult a broker, and you can just inquire about the value of the shares. And if you have enough money, even if you have money for one share, you can become a shareholder in a company. Risk-bearing capacity. This is the sixth advantage. The loss of the company is distributed to a large number of shareholders. So each shareholder bears very little amount of loss. Since there are more number of members in a joint stock company, the risk is being shared by more number of members, and hence the company form of organization has risk bearing capacity. Economies of large scale operation. What are the economies? What are the advantages of large scale operation? A joint stock company can undertake business on large scale, whereas it is not possible in case of sole trader or partnership. That will be restricted to the amount of capital invested by the sole trader or the partners. As a result, it can derive all the advantages of large scale production. So here they have given you an example. Hero Motor Corporation Limited 2015, the world largest seller of two-wheelers, manufacturers motorbike on a large scale and is able to enjoy cost efficiency. So large number of motor cars are produced by this concern, and it is earning large scale production is being carried on, and as a result huge amount of profit is being earned. So economic development is possible only in joint stock form of organizations. Joint stock company system has been responsible for rapid growth of industries and trade in many countries. Since joint stock companies have large financial resources, they are able to undertake large-scale production, satisfy the needs of more number of consumers, create large employment opportunities, promote balanced regional development, and contribute substantially to the government by way of taxes. And large number of taxes is also paid by joint stock companies. Since the investment is more, everything becomes more. Production is more, satisfying the needs of more number of consumers is more, creating large-scale employment is also more, promoting balanced regional development, and contributing substantially to the government tax treasury. So large amount flows from joint stock companies to the government's treasury. So government also automatically approves for the formation of joint stock companies rather than partnership firm or sole trader, since the amount that is derived or as revenue from these two organizations are comparatively less than the joint stock companies. So disadvantages, there are also certain disadvantages irrespective of the above 7 to 8 advantages that we have just seen. So the following are the disadvantages. As was true with the other forms of business organization, the corporation has some disadvantages. Some of the more obvious ones, clear ones are complexity of formation. Lots of rules and regulations and formalities have to be formed, and it is not easy for formation of a joint stock company. Creation of monopoly business. Only a particular number of people holding large number of shares. That is also in one of the disadvantages. Bureaucracy. Business being in the hands of some people. Nepotism, high administrative cost, overlook to the shareholders, scope of fraud, tied following of law, and expose of secrecy. So all these things are possible, and these are considered as the disadvantages of joint stock companies. Costly and difficult to form. So all the procedures, first of all, the procedures involved in this type of organization is very complex, and it is also very costly. Number of legal formalities must be observed in the formation of the company, and to observe these legal formalities, The promoters have to spend much time and money. So they have to spend a lot of amount to get the companies registered. Scope for dishonest and unscrupulous management. The directors manage the company with the help of paid officers, already we have seen. If the directors are dishonest, they may make personal gain at the expense of the company, and they may misuse their power and position. So this is not in the case of partnership, as they are having a personal contact between the business and the partners, or the sole trader and the business. They are considered one and the same. As a result, no secret matters are going to be leaked out, and management is done by faithfully by the sole trader or the management partners. They have mutual trust among one another, whereas that is not in the case of joint stock companies. Management oligarchy. A few rich persons may secure control over the affairs of the company. Thus, the management of the joint stock company might become oligarchic in character. Oligarchic means small group of people having control. If they are rich, they will be dominating the other members, and they will be holding all the shares in their hands. As a result, the people, those who are having a less amount of contribution, they will be suppressed by these people. So that is oligarchic management. Speculation. A few individuals may corner the shares to gain control over the company. So they may hold major shares in their hands and they may speculate, or they may just give a raise or fall in the share value according to their holdings. Lack of interest. The officers of the company do not have incentive to work hard. The officers will not be paid properly, and since it is all governed by the board of directors, so they are not usually inclined to take risk. They lack initiative. Lack of good labor relations. In sole trading business, personal supervision is possible. And in partnership also, the partners have the responsibility of supervising the firm's business. But in company form of organization, there is lack of personal contact between owners and the workers. As a result, there is scope for more industrial disputes in a company form of organization. So there is lack of management, ownership and management. So this should not be the case actually, and as a result many disputes arise. High taxation. So joint stock companies have to pay tax higher rates compared to other forms of business organization. This we already have seen in the previous explanations. So tax is also one of the tax payment is also one of the advantages, but it is also one of the features which is having a disadvantage, because we have to pay more too. As we get more return from the business, we have to pay more amount of taxes. So that is also considered as the disadvantages. So with this, we are winding up today's class, and thank you students for